Do you ever feel like no matter how much you learn about trading, there's always something missing? Like the real insights, the ones that separate professionals from the majority, aren't talked about enough. Well, after working inside the Chinese hedge fund, I picked up some lessons that completely changed the way I think about trading. These aren't your typical use a stop loss or follow the trend tips. These are insights that I never saw discussed inside retail trading circles. So in this video, I'm gonna share the 3 biggest lessons I learned, and they might just change the way you look at trading. Lesson number 3 is something that 99% of traders overlook, yet it has a huge impact on long-term success. So if you're interested in seeing how professional Chinese traders actually think and operate, make sure you stick around. Before we dive into the lessons, let me quickly share with you how I got there. I lived in China for 8 years, and for 3 of those years, I was working in Shenzhen. First as a junior trader in a prop trading firm, and then as an FX trader at a small to mid-sized hedge fund. Our Shenzhen office had about 25 traders, but we were part of a bigger network with offices in Guangzhou, Hong Kong, and Dubai. Despite the intensity of trading, the atmosphere was surprisingly friendly. We weren't just co-workers. We were a tight-knit group, learning from each other and improving every day. One of my favorite parts of the day was lunch. We had this amazing cook who would prepare us a delicious meal every single day. And when the clock hit lunchtime, we'd all sit down together, talk, and eat as a team. No charts, no trades, just good food and good company. That environment helped me grow, not just as a trader, but as a person. And in those years, I picked up some key lessons that I know most retail traders never get to experience. So let's start with lesson number 1, which is something that might completely change how you approach trading. One of the most counterintuitive lessons I learned at that Chinese hedge fund is something called the 90-10 rule. And no, this isn't about the cliche 90% of retail traders lose money. This is something completely different, and it blew my mind when I first saw it in action. Here is the concept. Professional traders have positions open 90% of the time and stay out of the market only 10% of the time. Now, that might sound reckless. You've probably been told that good traders are super selective, that they wait for the perfect setup. But that's not how professionals approach it at all. At least it wasn't in that Chinese hedge fund. In fact, the only time I remember them not having positions open was during the Chinese New Year holiday. And think about it this way. Casinos don't win on every single spin of the roulette wheel, right? But they always have the wheel spinning. Why? Because their edge is in play all the time. Over thousands of spins, that edge guarantees them profits. And hedge fund traders operate the same way. They don't sit around waiting for a once-in-a-month perfect trade. They are always positioned in the market, constantly letting their edge play out across different time frames. This is very different from over-trading. They still have well-defined strategies and strict risk management. But while a retail trader might place 5 trades in a month, a professional trader might have multiple positions open at all time, short-term, medium-term, and long-term positions, cycling through setups that all fit their strategy. The result? They're constantly compounding their edge over and over again. Now, here is the catch. This only works if you actually have a real edge. If you're just randomly trading patterns, then no amount of exposure to the market will save you. But if you have a strategy that actually works, then playing the game as much as possible is what gets you ahead. And speaking of strategy, here is the second surprising thing I learned. So here comes lesson number 2. Professional traders take trades that are actually fairly simple. One of the biggest myths in trading is that you have to use ultra-complicated strategies to succeed. But here is what I learned from the discretionary traders at the Shenzhen hedge fund. The best trades are actually shockingly simple. I remember watching these guys take trades, and at first, I expected some next level, ultra advanced strategy, but instead, they would just buy when something looked cheap and sell when it looked expensive on a specific time frame. And to do that, they looked for areas where price had previously been rejected. And that's it. They weren't blindly following technical indicators or waiting for 15 different confirmations. They had a deep understanding of order flow and market structure. So when a forex pair was trading at a level that was historically cheap for the day, for the week, or even the month, they'd buy it up with confidence. Conversely, when something felt overvalued in current market conditions, they would short it without hesitation. Now, here is the key difference between how they did it and how most retail traders operate. First of all, they weren't just looking at support and resistance zones and hoping for a bounce. They factored in order flow and market context before making a move. And here is the wildest part. Looking at their trades in hindsight, they seemed ridiculously obvious. Like after they showed why they took a trade, I would just sit there thinking, well, duh, that makes total sense. And that's the beauty of it. The best trades didn't feel complicated. They feel obvious in hindsight. Retail traders tend to overcomplicate things. They look for the perfect trade setup, they overanalyze, they hesitate. Meanwhile, hedge fund traders just execute on simple, high probability IDs. And that's the real secret. Trading doesn't need to be complicated. You don't need tons of indicator. You just need to understand the flow of money in the market and how it drives price, and then simply act on it. But even if you have a great strategy, there is still one thing that can make or break your success in trading. And here comes lesson number 3. Not trading alone is a tremendous psychological boost. When you think about it, trading is one of the loneliest professions in the world, especially for retail traders. You're there sitting at your desk, staring at charts for hours, making decisions that could cost you money. There's no boss to guide you, no coworkers to keep you accountable, just you, your screens, and your thoughts. And that's exactly where things get dangerous. When you're alone, your emotions can take over. You hesitate, you doubt yourself, you revenge trade, you overanalyze. You can actually watch my video about Marty Schwartz and how a mistake cost him $800,000. This is a great trading anecdote about the dangers of trading alone. But here is what I noticed at that Chinese hedge fund. The traders weren't alone. They worked in a team environment, and that completely changed the psychological game. When someone would take a series of losses, others would truly try to cheer that trader up. When traders were on a winning streak, our boss would keep them grounded and make sure they didn't get reckless. There was constant ID sharing, motivation, and a very healthy sense of competition that pushed everyone to get better. It's something I had never considered before, but once I saw it in action, it was obvious. Trading in a team environment makes you a better trader. Now, I get it. Not everyone has access to a trading floor. But here is what you can do. Join a community of serious traders. Find a Discord or Telegram or online group where traders actually share ideas and genuinely care about the success of one another. Get on voice chats. Even if you're just trading quietly while others are in the same room, the psychological benefits are massive. Surround yourself with traders who are better than you. The fastest way to level up is to be around people who force you to improve. The bottom line, trading is hard. But trading with a solid group of people makes you take accountability and pushes you to get better. So let's recap the 3 biggest lessons I learned from working at a Chinese hedge fund. Number 1, the 90-10 rules. Professional traders have their edge playing 90% of the time. Lesson number 2, simple trades are the best trades. The best setup aren't complex, they're just well-timed, high-probability trades. Lesson 3, trading alone can be a psychological killer. So find a community and watch how much your mindset approves. Now, if you got any value from this video, please smash the like and subscribe button. I'll be very thankful, and I'll make sure to drop more behind-the-scene trading insights soon. And please let me know in the comments, which of these 3 lessons surprised you the most? That's it for today's video. I'll see you very soon. Ciao.